So I'd like to welcome Jonathan Chevreau to our show. John is an author, CFO, and founder of the Financial Independence Hub, North America's gateway to financial independence, the investing editor at large with Money Sense magazine. And many of you may recognize him from the personal finance column he wrote at the Financial Post for 19 years. Welcome to the show, Jonathan Chevreau. Thanks for coming.
Thank you for having me, Alan.
My pleasure. And I know for some of you that recall, we had Jonathan out last year, and markets have changed a lot since then. And as usual, want to strike up a conversation, just a general conversation, and get your thoughts as to where you think markets are today. So, overall, where do you think we stand with respect to the markets? We have the U.S. markets up quite a bit for the year. We have a few charts that will show that. The NASDAQ up about 28-30% for the year. S&P 500 up about 12% for the year. Whereas the TSX, struggling a little bit, only up a few percent this year. So I guess to sum it up in one question, would you be an investor today, or would you be on the sidelines?
Well, I'm never on the sidelines, nor to advocate it. I believe in long-term strategic asset allocation. That said, obviously we've come off a terrible 2022. It was the worst year for balanced funds, balanced ETFs in like more than a decade. You tell me, maybe 20 years. As for the U.S., they just declared the S&P 500 back in the bull market just last week, and largely on the basis of those 7 big mega cap tech stocks, Apple, NVIDIA, and some of those, Microsoft. Meanwhile, Canada, yes, sort of mired with a lot of the energy and the resource materials, even the banks, a little bit iffy. Personally, I'd say it sounds like a chance to rebalance a little bit and take some profits from the big mega cap U.S. stocks as the S&P broadens out. The market kind of the bull broadens beyond the 7, and redeploy some of those profits back into Canada.
Yeah, what you say makes a lot of sense. Last year was I think the 4th worst year since World War II for the S&P 500, down over 20%. I know the NASDAQ down about, I think, even over 30% last year. So even though the run we've seen in those two indices, still not back to where we were prior to or at the end of 2021. So yeah, you make a great comment. The traditional 60-40 split type of portfolio really struggled last year. And perhaps a good time to diversify. Would you look at buying some of the areas of the market that haven't participated in the rally yet? Or would you jump on the tech bandwagon and maybe own some names in that space?
Well, I was always on the tech bandwagon, since I used to be the Globe and Mail's technology reporter back in '84. So I've always had, again, but it's strategic. To me, tech is one portion of a diversified portfolio. Yeah, I own NVIDIA, and I have for a few years, but I'm sure you can find a few dogs in my portfolio as well. A lot of people got caught up in the 2021, 22 SPACs and IPOs. A lot of them were technology, and I can show you a few names that are down 90%, particularly in the EV space. So personally, at my age, I just turned 70, so I know your readers and viewers will be probably a little younger, 10 or 20 years out from retirement. But even though I'm not leaving the markets. It's a nice time for the fixed income portion of one's portfolio to be in, GICs, kind of ladder over 5 years. You can get 5% now, and so that's nice. I was chatting with a few people. There's a bunch of investment writers that have lunch every spring, and a couple of them were for the Globe and Mail, and they were all talking about, apparently that's the big one ETF does it all pick over there is VBAL. My daughter is in the first home savings account, just started it up to buy a home. And I said, what do you want to do? She said, I'm just adding to VBAL, Dad. I'm dollar cost averaging. She's 31.
Yeah, no, it makes a lot of sense. And I know we have a couple of charts on the NASDAQ. We can show those S&P showing how much they've grown and how well they're doing over the past really 6 months or so, and TSX not doing as well. But overall, I want to kind of flip our conversation over to Bank of Canada, and overall, there are a lot of pushback with respect to what the Bank of Canada did most recently, raising 25 basis points, at their most recent meeting. Do you think they were justified to start raising again? Obviously, they paused as of January. I think it was 2 meetings that they didn't raise again, and I guess they felt the need to raise rates. I know inflation went up from 4.3% in our country to 4.4%, but would you have remained on hold, or do you think they were justified to raise those rates?
I don't think you can criticize 25 beeps either up or down at this point. I mean, clearly they're still nervous about inflation, as they are in the States. You know, the data the last couple of days, even in the States, has been relatively favorable. Inflation is still there, but it's coming down. I think first of all, I think Canada paused, didn't we? And then we went back in. Right now, later today, we're expecting the Fed to be on pause. At least 2/3 of the pundits think it's going to pause. Another third think maybe they're going to just inch it up another 25 beeps. I don't think it's significant. You know, it's not for me to criticize the Bank of Canada. You know, I think they're doing a reasonable job. And again, if you have a diversified portfolio across all asset classes, geographies, market caps, etc., I don't see the need to really worry too much. As for the fixed income portion of a portfolio, again, it's an opportunity to lock in rates we've never had for 5 years or so. So, you know, compared to 2022, which was, you know, if you survive 2022, so far 2023 is looking pretty good.
Yeah, and again, another great point. I guess it just depends on what type of investor you are. Many individuals that are in retirement looking for that steady income for many years, I know they would say to me, Alan, you know, we can't be in these fixed income products. They just weren't paying enough interest. Now they're in that 4 or 5% range, 4.5%, 5% range. I know even if you go to the US, you can buy like 30, 60, 90-day treasuries that are 5% yields. So things have changed quite dramatically, and I'm sure things will continue to change. But, you know, you bring up later today what the Fed is going to do, and I struggle with that. You know, a lot of people think they're going to be on hold or pause to perhaps raise again in July. So I'm just thinking if the Fed thinks that they're going to raise in July, they might as well just raise today in June. I just don't see the reason for a pause. And then when you talk to certain individuals, they say, well, they just want to take stock of what's happened. You know, they've raised rates 5% basically, or 11, 12 times in the last just over a year. And they want to see if it's justified. And then you talk to others and they're saying, well, they're done. If they pause, they're not going to go back into the water and raise again. But then again, you had Canada, Australia, pause and then raise. So again, more confusion for the average investor. Do you think the US should raise? Like, do you think they're going to? I know the talk is they won't, but would you expect a raise later on? Do you think their economy is still hot enough that they will have to raise?
Yeah, I mean, they've raised what, 10 times in a row now. So I think almost everybody expects them to pause today. I think it's sort of like we're at the end of they want to make things look stable at the end of the first half, at the end of June, which leaves, you know, that way they can say, you know, we're halfway through the year and now we can see the data. Now, I would expect late in July that they will raise another 25 beeps. You know, then we'll see. Maybe they'll be done. Maybe be another 25 September. I don't know. But obviously, we're a lot closer to the end of the hiking cycle than we were a year ago. I mean, we're already into kind of uncharted territories. You know, it all depends on, you know, whether this much feared recession happens or not, which I guess we can talk about.
Yeah, and you know, you're right. I think we are closer to the end of the hikes, and I think that's why the market is doing as well as it has, or as well as it's doing in the U.S. And hopefully we can get our banking sector, we get a little bump up in the price of oil, not too much because we don't want to pay more at the pumps, but that'll help the oil sector, the banking sector here in our country, and we can see the TSX move higher as well. But at the end there, you mentioned the word recession, and I guess to sum up, or to the last question I have for you for this show is, do you think we're gonna fall into, or maybe fall into maybe a mild recession? Do you think we're going to have a bit of a soft landing where we don't get really a recession? You know, what are your thoughts? I think everyone's pricing in a recession over the next 6 to 12 months. I've never priced it in fully myself. I always thought there was a chance for a soft landing, that we could kind of skirt by, maybe get down to flat line, but not move into the red. What do you think? Do you think a recession's in the cards here in Canada and or in the US?
Well, some people seem to think that we're going to have some sort of recession. So if you kind of have, that gives you a lot of wiggle room. If you ask me, are we in for some sort of recession in the next 6 months to a year? I'd say, yeah, some sort, perhaps. Whether it's mild, soft landing, that's all just semantics. Again, I don't think it really affects people. It shouldn't affect your investing strategy. I mean, I suppose if you really believe it's going to be bad, you can kind of like keep in cash what you already have, take profits on the NVIDIAs and the AI stocks if you've got them, big, massive gains. But I don't think there's any need to panic. And there are defensive areas. I mean, I know Dale Roberts is often, I rerun his blogs. He's a cut the crap investing on the Findependence Hub. And I've run a couple of interesting pieces by him, which talk about where the defensive ETFs are. And he likes, for example, consumer staples ETFs. Staple, for example, is a BMO ETF. A global, there's one of iShares, one of the Canadian ones, which is basically just grocery stores. Pharmaceutical and health is another sort of defensive sector. Utilities, global utilities. I think Harvest has a global utilities ETF. So there are areas you can shelter in. You don't have to just shelter in cash and GICs. Again, nobody can predict the future. No one asset class is ever going to be perfect. I mean, right now, Wall Street's starting to talk about China and emerging markets. I mean, Gordon Pape in the Globe and Mail today, that is on Wednesday the 14th, was singing the praises of China and emerging markets for the first time in a long time. You look at your portfolio, that's been down, but that's the art of investing. And I'm sure you would say the same to your clients, Alan.
Yeah, no, 100%. And I actually take it one step further. I actually think a lot of this recession talk was built into the market even last year when we saw the markets fall as much as they had. So I agree. I think you keep your investment strategy. Obviously, there are places to move into for defensive purposes. But overall, I think if you're an investor, that's all part of it. And over time, this ends up a blip on a chart and you just move forward. But Jonathan Chevreau, I want to thank you for joining us this afternoon. Always a pleasure having you and sharing your ideas about the markets. And I look forward to having you back again down the road.
Thank you, Alan. Anytime.
All right. All the best. Take care.